On the surface, it looks like Canada is on the ropes in the 2025 trade war. The headlines are all about American pressure and a Canadian economy that's just bracing for impact. The story everyone tells is one of American strength and Canadian retreat. But what if that's not the real story? What if the numbers that actually matter, the official data hidden below the headlines, tell a completely different and frankly shocking story? Everyone seems to think Canada is getting crushed. But when you look past the noise and dig into the data, a surprising picture starts to take shape. It reveals an economic fight where the very definition of winning isn't what you think it is. Today, we're breaking down the data that uncovers this hidden truth. This isn't the story you'll see on the news. This is the story the numbers are telling. Number 1, the great GDP fakeout. First, you have to look at the biggest number of all, gross domestic product, or GDP. It's the go-to measure for a country's economic health. And at first glance, the story it told earlier this year looked pretty good for Canada. In the first quarter of 2025, the Canadian economy posted a surprise GDP growth of 1.8% on an annualized basis. In a climate of intense trade pressure, that number seemed like a sign of incredible resilience, suggesting Canada was weathering the storm with real strength. But this is where the popular story gets it wrong. That number wasn't a sign of strength. It was the result of a short-term, unsustainable panic. It's a classic case of tariff front-running. Knowing that new steep U.S. tariffs were about to hit, Canadian businesses rushed to ship everything they possibly could across the border. Before the hammer fell, they pushed everything: machinery, cars, lumber, even food, in a mad dash to beat the deadlines. This created a temporary, artificial bubble that boosted export numbers and, in turn, puffed up the GDP. But every bubble has to pop. And boy, did it ever. The moment the tariffs hit, the numbers reversed with brutal speed. After that Q1 surge, the economy immediately started showing signs of strain. Forecasts from organizations like the OECD now paint a much bleaker picture, projecting Canadian GDP growth will slow to just 1.0% in 2025. This isn't a story of winning. It's a story of a sugar high followed by a painful crash. Those early GDP numbers weren't a sign of victory, but a clear warning of the disruption to come. Number 2, the export mirage. That leads us right to the next piece of this false narrative: exports. For a trading nation like Canada, export numbers are everything. And just like with GDP, the initial figures in early 2025 looked almost too good to be true. Because they were. Canadian goods exports jumped by about 7.5% in the first quarter of 2025, thanks to that front-running frenzy we just talked about. But what happened when the clock ran out? The reversal was swift and severe. In April 2025, as tariffs took hold, total exports plummeted by a massive 10.8%. Exports to the United States, Canada's biggest customer, fell by about 13% in that 1 month alone. Key sectors got hammered. Motor vehicles and parts, the heart of Ontario's manufacturing sector, saw exports fall by 16%. Industrial machinery dropped by 20%. This wasn't a dip. It was a nosedive off a cliff, and the pain has continued. May marked the 4th straight month of declining goods. Exports to the U.S., Canada's share of exports heading to the States, has fallen from a 2024 average of around 74% down to just 68% by May 2025. Sure, there was a slight uptick in exports to other countries, including a record high in May thanks to a surge in gold shipments to the UK, but that doesn't come close to fixing the damage. A one-time gold rush isn't a sustainable economic plan. The hard data shows that in its core trade, Canada isn't winning. It's taking heavy blows, month after month. Number 3, the human cost of the trade war. This isn't just a battle of statistics. The consequences of this trade war are hitting real people, in their jobs and their hometowns. A temporary surge in exports might look good on a spreadsheet, But the downturn that follows has a very real human cost. The unemployment rate in Canada has been climbing. In May 2025, it rose to 7%, the highest it's been in a decade, if you don't count the pandemic years. This isn't a coincidence. The job losses are happening exactly in the industries most exposed to the trade dispute. Manufacturing has been hit especially hard, shedding tens of thousands of jobs since the year began. Just look at Windsor, the heart of the Canadian auto industry and a city targeted directly by U.S. tariffs. Its unemployment rate recently shot up to nearly 11%. These aren't just numbers. They are canceled factory shifts, laid-off workers, and families suddenly facing an uncertain future. Some analysts have even warned that Quebec alone could lose up to 100,000 jobs if this tariff fight keeps escalating. The pain is also spreading to wholesale, retail, and trade sectors. And when people lose their jobs, it's getting harder to find new ones. This creates a ripple effect. When people are out of work or scared of losing their job, they spend less. That reduction in spending drags the whole economy down further, creating a vicious cycle. The data is clear. The trade war is hurting Canadian workers and their families. Number 4. The investment chill. There's a fourth, less obvious casualty in this trade war. Business investment. This might be the most critical factor for a country's long-term health. Investment in new machinery, equipment, and technology is what fuels innovation and future growth. And right now, that investment is being put on ice. The reason is simple: uncertainty. When businesses have no idea what the trade rules will be next month, let alone next year, they hit the pause button. They delay major purchases and shelve their expansion plans. Think about it. Why would you invest millions in a new factory if you're worried that new tariffs could suddenly make your products too expensive for your main market? This isn't just a theory. It's happening right now. The Bank of Canada has pointed out how this cloud of uncertainty is causing businesses to delay or cancel investments. This has dangerous long-term consequences. A lack of investment today means a less competitive and less productive economy tomorrow. It slows innovation and can lock in a pattern of weak growth for years. While headlines focus on the daily drama, this quiet freezing of business confidence may be the most serious damage being done to the Canadian economy. Number 5. Adaptation is not victory. Now, this doesn't mean Canada is just standing still and taking the punches. To be fair, there are clear signs of adaptation. Canadian governments are working to lower trade barriers between provinces to boost the domestic market. Businesses are aggressively searching for new export markets and trying to diversify their supply chains so they aren't so reliant on the US. And there's real investment going into future-proof sectors like clean tech and AI. These are smart and necessary moves. They are the actions of a country trying to build long-term resilience. But we have to be clear. Adaptation is not the same as winning. These efforts are a reaction to an economic injury, not a sign of dominance. Finding new markets is crucial when your biggest customer is penalizing you. But it's a slow, tough process that can't replace the massive trade with the US overnight. These are survival tactics. They are about minimizing the damage and building a stronger economic foundation for a future where Canada is less vulnerable. And while these strategies are essential for the long run, they don't change the reality shown in today's data. In the here and now of 2025, the Canadian economy is taking on water. Conclusion. So, let's go back to that original question. Is Canada really winning the 2025 trade war? While the daily headlines can be confusing, the underlying data tells a clear story. That initial spike in GDP and exports was an illusion, a bubble created by companies scrambling to beat a deadline. The reality that followed has been one of falling exports, rising unemployment, and a chilling drop in the business investment needed for a healthy future. The surprising truth is that the narrative of Canada winning is a myth. The reality is that Canada is in a tough, painful economic fight. The country is adapting and making smart long-term plays. But based on the immediate economic numbers, the hard data on jobs, growth, and trade. The story is one of significant damage. In this fight, winning isn't about landing a knockout punch. For Canada, winning right now means surviving the storm while strategically setting itself up for a more independent and resilient future. If this analysis gave you a different perspective, hit that like button and subscribe for more deep dives that go beyond the headlines. We want to hear from you. Based on the data, do you think Canada's strategy of long-term adaptation is worth the short-term economic pain? Let us know in the comments below.